blockchain, actually. We'll talk about that in just a little bit. But this is kind of just a microcosm of what we're dealing with when we're talking about the financial markets. Here's another picture. This is the VIX index and the S&P 500. And the VIX is the white line, and the S&P 500 is the green line. So you can see they're inversely correlated. Actually, at the end of this graph to your right, the VIX has gone up more and the S&P has gone down more. But this week, it's been crazy, right? We've seen like 30, 40-point moves in the S&P 500 just this week alone. Wednesday had a big sell-off. Yesterday had a big rally. Now it's down again today. And we had the U.S. GDP number come out at 3.5%, which kind of stabilized things. So a lot of market volatility. What we're going to do today is I'm going to provide you a structure or a paradigm to look at how the markets are reacting and what they're doing. And to do this, we're going to have a little bit of fun because we're going to go back to 1487 and the development of Newtonian physics, right? Anybody take physics in their education? No one's raising their hand? Don't feel bad, I didn't either. So I had to learn it myself. Don't worry, we're not going to get into the math. It'll be safe. You won't be harmed by this. But the reason why we're going to do that is because within that framework, it really will aid you in understanding how these markets look at the world and why they do what they do. Now, fortunately, let's see. Let me get a little closer to this and maybe it'll work. It's not advancing. One more time. There we go. So we're going to talk about a story. And to talk about stories, we're really talking about what we call market narratives. And just to level set everybody, this is what Bob Shiller, Nobel laureate, calls the economic narrative. Now, he just wrote a paper in 2017 on this subject. It is one of the most understudied subjects that's out there. This is the narrative that drives market values. It is the story in the marketplace that is telling you, if things are all really bad, that and things are being interpreted negatively, every story that comes out is being interpreted through that lens of that narrative. If things are really good, it's the opposite, right? And I just want to warn you, last year in 2017 was the least volatile year that I can remember in the history of my career in finance. It barely, the S&P 500 barely pulled back ever 2%. So by definition, 2018 is going to be a bit more volatile. It'll feel more volatile overall. But I will tell you that there's other forces at work here that are going to drive this market narrative that I've been watching really since the beginning of the year and been informing the commission on. And so what I'm going to do today is run you through what that looks like. Now, to do that, this is what I'm interested in kind of working with you on. These are the three topics or three big drivers of market values that are out there. Global central bank policy, US domestic policy, and fintech. Now, yes, here we are in the United States, so I'm going to be a little US-centric in what I'm going to tell you, but there's a reason for that, especially when it comes to the central banks, because what we're doing here in the United States is vastly different from what's going on in the rest of the world. And again, I want to be really clear about this. We're going to talk about a lot of different things, but this is the market narrative. This is what we watch. This is not my opinion. This is what market players are telling us. This is what we're reading. This is the books that we're reading. This is what's driving this thing overall. Now, here's the paradigm. Who's ever heard of the three-body problem? Actually, it's a series of books by a great Chinese writer, science fiction. If you ever get a chance to read them, they're awesome. They make Star Wars look like a kiddie show. They are really great, and I think somebody just bought the rights to them. I know a movie's been made of them in Chinese, but I think there's a U.S. Company that's going to develop them. There's 3 books to it, and I think it's going to cost them, they estimate it's going to cost them $1 billion to produce these 3 movies, if it's just 3 movies. The stories are fantastic. But one of the things they talk about in this book and in Newtonian physics is the three-body problem, or the three-particle problem. Now, when you're trying to figure out what physics is, it's really just how energy changes motion, right? I mean, then very simply put. So when you start talking about particles or planets that have mass, right, that have gravitational pull, right, that's something that changes the energy and changes the motion. So when you have two of them, it's pretty simple, right? If you're looking at the Earth and you're looking at the moon going around the Earth, you know, we can evaluate that, and they could do that actually back in 1487. The challenge is that it's not just two things, right? It's the Earth, the moon, and then you have the sun. So this is what we're trying to figure out. This is what the financial markets are trying to figure out, is the different gravitational pulls of those three topics that I mentioned: global central banks, U.S. domestic policy, and fintech, and how they influence the markets at times. So for our purposes today, we're going to say the sun is global monetary policy, we're going to say the Earth is U.S. domestic policy, and we're going to say the moon is fintech. And the reason why we say that is because global central banks have the biggest pull on the financial markets. And so they have the biggest mass and therefore the strongest gravitational pull. Every time the Fed is doing something, or the European Central Bank, or the Bank of Japan, or the People's Bank of China, and go down the list, people sit up and pay attention to that. And the markets pay attention to it mainly, more than anything else, even earnings. Because they have such a dramatic effect. Because why? Because interest rates have the biggest effect on the economy, right? That cascades out through everything that goes on, including earnings, including how the stock market evaluates those earnings going forward. So when we talk about the Fed, and when we talk about global central banks, we really focus on the Fed. Why do we do that? Go back to 2008, right? In the middle of the crisis, everybody around the world, I'm talking everybody, all these central banks, we're trying to figure out how can we stimulate growth, how can we stave off the bad things that are happening. And of course, what did they do? They cut interest rates, right? That's the first tool of monetary policy. But at some point, that wasn't really working so good. It really didn't have the impact that we wanted it to have to stimulate the economy. So then they started stretching themselves and trying to think, well, what other levers can we pull? And of course, they landed on quantitative easing. And that's where the central banks began to accumulate assets to force down the longer end of the yield curve, or force the yield curve down overall. Right, so if you think about it, this is going to be really technical. I'm going to show you on my arm here. This is the yield curve, right? So they cut interest rates, that's the short end, and then they did quantitative easing, that's the long end. That's the goal, is to force down rates. And when you do that, you make money cheap, right? And if you make money cheap, then companies can start to feel a little bit better about their costs, but they can also look at projects a lot differently, thinking about the discounted cash flows that they anticipate going forward when they do a project, right? If interest rates are at 10%, it's really hard to get over that hurdle. If they're at 0, it's a lot easier. And actually, that's how a lot of equity analysts look at stocks overall, right? That's kind of the theory of when we're looking at values of stocks, is discounted cash flow, right? In the numerator, you have the cash flow or earnings of a company.